Welcome to another episode of Economics 101, our short video format where we present some concepts in economics in simple terms. Today we're going to talk about inflation, what it is, and how we can protect ourselves and our money from it. If you're new here, then consider subscribing. We have quite a lot of content on economics and business that you might enjoy. But for now, let's focus on inflation. Put it simply, inflation is the increase in prices of a selected assortment of goods that is calculated year on year. Throughout history, inflation was an effect that was more or less as likely to occur as deflation, the generalized reduction in prices, and less of a constant climb towards ridiculous prices. It wasn't until the 20th century when the true effects of inflation really took place. If you ask someone that was young enough during the previous century, they will be able to tell you that things now simply cost much more than they did in their time. And it is true. By some measurements, Americans born in the beginning of the 20th century would have seen prices rise by 1,000% towards the end of their lives. This could have been caused by many things, from the break with the gold standard, which made the price of money tremendously more volatile, to sharp increases in oil price, to an evolution of society, from industrial to service-based economies in the West. Economists largely agree that a given percentage of inflation a year is nothing to be too scared about, so long as it is kept between 1 and 2.5%. The central banks are generally considered to be responsible for ensuring this effect, though as we have seen nowadays, they are not always successful. Essentially, too much inflation is bad because it brings into question the value of a unit of currency and largely compromises the entire flow of capital. This is called hyperinflation, and the most popular example of it could be seen in the interwar period of the Republic of Weimar in Germany, where the German mark was so worthless that it made more sense to burn the money than buying wood to keep warm at night. However, the opposite of inflation, deflation, is also dangerous. This might sound a bit counterintuitive, since lower prices might be a good thing, but it causes tremendous damage across the economy, since buyers are incentivized to wait for the next day when everything will be cheaper. If they do so every day, then the economy grinds to a halt, product stocks increase, and people get fired from their jobs since the company is no longer producing. So, there is a fine equilibrium to be reached when dealing with inflation. Too much and the country's currency becomes worthless and compromises the entire system. Too little and consumers will be incentivized not to spend today and save for tomorrow. So, what do you think? Is inflation a natural evil of our economic system, or is there a better way to deal with the evolution of prices? If you're enjoying these videos, I will leave a few more on the screen so you can check them right now. Thank you for watching, and I will see you in the next one.